Okay. Let's dive into some information we may encounter on a fact sheet. Let's say I become interested or somebody else becomes interested. They pick up a fact sheet for a fund. They may come across a lot of terminology there. And one thing that's sometimes thrown at us is the fee structure of a fund is a 2 and 20. And I may have this reversed, but what does that mean when I hear numbers like that?
Sure. So what those numbers mean is the first number is the two is the ongoing annual cost or fee for the company to manage the fund for you. And that is typically going to stay stagnant. That doesn't change. The 20% or the 20 number is indicative of the percentage of returns that the company will share with the investor beyond usually beyond other statistical features of the fund, such as what's called a hurdle rate or a high water mark. So without going into for the moment what those two are, if we achieve those hurdle rate and high water marks, they're saying anything beyond that achievement, we are going to share the returns 20% to us and 80% to you.
I see. Okay. And now the hurdle rate though, if is that basically the rate of return that goes entirely to the investor and beyond that that's where the performance fees come in?
So just like you would think it means, the hurdle rate is the percentage, and always positive, of course. The percentage hurdle rate is the rate of return from a positive perspective that the fund has to achieve, which goes all to the investor before we start looking at performance fees. So that number can range anywhere from a specific number to, say, a specific percentage above index returns. So some of them are a moving target and some of them are a stagnant target.
So 20% at first glance to some people can seem like a large number. I know where we're taught to reduce fees or minimize fees where we can. 20% seems like a high number. Why or why not should I care so much about that number? Maybe just talk to us a bit about that.
Sure. And yes, it does seem like a high number. Where we encourage investors to not care, but understand the fee structure better so that they know why they're paying it, is because that 20% shared return is one of the only times in life where the investor has to share, or excuse me, rather, where anyone has to share a return or a cost, um, where they're only achieving a positive result. So we all know in other aspects of life, you still have to pay for your services, even if you don't necessarily get what you wanted. You can't exactly not pay your bills just because you didn't get the desired result, right? Whereas here, you're not sharing that 20% with the company unless they achieve their desired result. And again, if I had a quarter for every time I heard a client say, I have no problem paying costs and fees if I'm getting what I'm supposed to be. And in the same breath, if you talk to them about performance fees, they're like, whoa, those are scary. But it's like, it's actually what you just said. You only pay fees and you only share the cost or the results rather with the fund if they achieve a positive return. I think it would be just really quickly important to understand what these terms. We discussed hurdle rate, but the high water mark is the bigger one where people will understand more. The high water mark, it's not just the hurdle rate. They have to achieve what's called a high water mark, and the high water mark is basically a way of describing that the fund cannot collect a performance fee unless the fund is trading at the highest level it's ever been at. So imagine you can only collect a performance fee if first you achieve a minimum rate of return, and then for the company to continuously keep collecting their portion of the split between you and the investor and the fund company's net asset value has to be consistently and always trading at an all-time high. So when I put it to investors like that, they're kind of like, oh, well, okay, like I'll do that, but it's not really explained well when you just hear things like alternatives have high fees. So It's one, like I said, I'll end where I started. It's the one of the only places in life you can actually pay for what you get. And this year being a bad year, you can be rest assured nobody's paying performance fees this year.
Right. Fair enough. Now, what if somebody holds a certain alternative fund and then sells that fund or gets rid of it in a certain time frame? Can there be a fee on the back end for selling that? Does that come up at all?
It does, and again, this is again a case by case. Some have none of those features, others do. It is number one, it is incumbent on the advisor to explain to their client that if there is a minimum holding period, that there should be an explanation to the client as to why there is one, and that there is one. And the second part is there those types of funds generally that have some type of a charge to get out within a specific time period are doing so because the investments are in an asset class that are not easily liquidated, and really try to ensure that if the investors are getting involved in a certain type of strategy, that they're doing so with a more long-term view in mind. Because, for instance, in a real estate portfolio, it's not so easy just to sell buildings if people want to liquidate.